Imagine your rent just went up by $200 a month, not because of inflation, not because your building got a new gym, but because an algorithm noticed you bought a golden retriever last week and mathematically calculated that you are now 40% less likely to endure the hassle of moving.
Right. I mean, it sounds like a dystopian science fiction novel, but it is the baseline reality of the residential market in 2026. We were talking about predictive yield management applied to basic human survival.
Usually when we look at a $30 trillion global market like real estate, $30 trillion, there is this expectation of permanence, like a mountain, you know. For a century, property was governed by this deeply human, highly inefficient, and frankly, very physical trinity.
The local bank lender, the human appraiser, and the municipal zoning board.
Exactly. It was a market entirely built on information asymmetry, gut feelings, and the standard 30-year fixed mortgage. You shook hands, you walked through the house, you haggled.
And it was comforting in its tangibility. We like things we can touch. We like looking the loan officer in the eye, dropping a stack of paper tax returns on a mahogany desk. We relied on human appraisers who would drive past your house, glance at the neighborhood, look at a similar house 3 blocks away, and just make a highly subjective guess about value.
But the physical earth is quietly being digitized. It is being turned into tokenized, data-rich nodes on a global algorithmic grid, which is exactly why we have a massive stack of research on the table today for this deep dive.
Yeah, the paradigm has completely shifted.
Okay, let's unpack this. Our mission today is to break down the mechanics of what is essentially an artificial intelligence real estate cartel. We are watching the rules of property ownership being rewritten in real time. The old mantra that everyone thought was the immutable law of physics in real estate location, location, location has been completely redefined by machines.
Machines that understand the monetary value of a location far better than any human ever could. Because we are no longer just trading dirt and wood. We are engaging in a massive, coordinated algorithmic land grab.
Right, and we're going to map out the sheer scale of this optimization. We will look at how you, the listener, can navigate this unprecedented wealth transfer. And crucially, we have to examine the new corporate neo-feudalism it is leaving in its wake. Because there are invisible walls being built around neighborhoods right now.
The overarching theme here is the shift from human inefficiency to mathematical extraction. If we really want to understand how the residential housing market has been fundamentally altered, we have to track the evolution of the corporate landlords, specifically the death of free market rent.
Right, because, well, 10 years ago, you had what we could call Web 1.0 corporate landlords. Private equity firms like Blackstone realized that buying up thousands of single-family homes and renting them out was a highly lucrative, inflation-proof asset class.
But they faced a massive physical bottleneck back then. Managing thousands of scattered homes across multiple states was a logistical nightmare. It required legions of human property managers, local maintenance crews, and, crucially, subjective human decisions about how much to charge for rent in every hyperlocal micromarket.
And we saw the primitive first wave of software trying to solve this. I mean, remember the major antitrust lawsuits back in 2024 around companies like RealPage?
Oh, absolutely. According to the Department of Justice filings from that era, human landlords were essentially artificially inflating rents across entire cities by looking at the same centralized software dashboard and coordinating their pricing.
But that was still human executives making clumsy choices. They were looking at a screen and clicking a button. What we are seeing today is profoundly different. The institutional AI landlord does not suggest a monthly rent price to a human manager. It operates an autonomous, hyper-local, real-time yield management engine.
The shift is in the fiduciary algorithms. You have software agents managing portfolios of 50,000 or more units across the country, and the agent's only directive, its entire encoded reason for existing, is optimizing the financial yield of every square inch of that portfolio.
So to do that, the AI has to calculate a tenant's exact price elasticity.
Yes, down to the dollar.
Okay, let's look at exactly how that works, because this is where the data plumbing gets incredibly invasive. The algorithm isn't just scraping public housing listings to see what the building across the street is charging anymore, is it?
Not at all. It is ingesting real-time alternative data streams to build a proprietary view of the market. For example, based on API documentation we have reviewed, the system monitors localized foot traffic by purchasing aggregated, anonymized cell phone ping data from major telecom providers.
Wait, so it knows who is walking outside my apartment?
It cross-references those location pings to calculate the exact volume of pedestrian foot traffic outside a specific apartment building. It knows if 300 people walk past the front door on a Tuesday afternoon versus 2,000 people on a Saturday night. It uses that foot traffic as a real-time proxy for neighborhood vibrancy and safety.
Wow. And that directly correlates to how much of a premium it can charge. It is measuring the literal pulse of the street.
Exactly. But it goes way beyond just who is walking outside.
Right. I was reading how these APIs integrate with municipal utility grids. This blew my mind. How does the AI use water pressure to determine if an apartment is vacant?
Well, think about a traditional human leasing agent. They might look at a spreadsheet and think a building is fully occupied because, all the leases are signed and the checks are clearing every month.
Sure, on paper, the building is full.
But the AI pulls the real-time smart meter data for water usage and sewage output. It notices that 20% of those supposedly occupied units haven't run a shower or flushed a toilet in 14 days.
Oh, wow.
Right. The machine instantly understands that those tenants are traveling, or they use it as a secondary home, or they are just living elsewhere. It reveals the true real-time physical occupancy rate of the neighborhood. This allows the algorithm to adjust pricing based on actual physical supply and demand rather than just paper supply.
And it is scraping local corporate job boards by the second, too. If a major tech company posts 500 open engineering roles in Austin, Texas, the algorithm detects that hiring surge.
And it immediately raises the rent on all available units within a 10-mile radius.
Before those new hires even finish their interview.
Exactly, let alone start looking for apartments. It is pricing in the human migration before the humans even pack their bags.
It is wild. But that is all macro-level data. The underwriting gets deeply personal when an individual applies for a lease, like we mentioned at the top of the show. You are not negotiating with a human leasing agent who might give you a slight break on the monthly rate because you have excellent credit.
No, if you apply for one of these units, the machine is evaluating you to find your exact breaking point. It factors in your estimated commute time based on the geographic location of your employer. It looks at your digital footprint to understand your spending habits. And then we get to the behavioral markers.
The dog.
The golden retriever scenario is a perfect illustration of algorithmic leverage. Actuarial data proves that dog owners have a statistically massive reduction in the probability of moving out within their first 12 months.
Because moving is already a high-friction event.
Right. And moving with a pet is exponentially more stressful. You have to find another pet-friendly building, you have to pay new non-refundable pet deposits, and you have to disrupt the animal's routine.
So the algorithm looks at my profile, confirms the dog, and mathematically deduces that my threshold for pain, meaning my willingness to absorb a rent increase, is significantly higher than a single person without a pet.
Precisely. It intentionally pushes your rent to the absolute mathematical limit just before the cost of moving becomes cheaper than staying.
It feels a lot like the dynamic pricing we used to see with airline tickets. You search for a flight to Chicago, you leave the page, you come back an hour later, and the price is suddenly $200 higher because the system tracking your cookies knows you absolutely need to be in Chicago by Friday.
That airline dynamic pricing model was the prototype. But now they're applying that exact same mathematical extraction to fundamental human shelter. The AI offers you the apartment at the absolute maximum threshold you're willing to pay before you mathematically decide to walk away.
Which brings up a massive structural issue. If every major corporate landlord is using these autonomous agents, how do they avoid undercutting each other? I mean, if I am a human landlord and the guy across the street drops his rent by $50, I might drop mine by $60 to steal his tenant.
Right, that is basic free market competition.
But the algorithms don't seem to do that. They have created an implicit price-fixing mechanism without anyone actually breaking the law.
Yes, and this is crucial. Historically, to fix prices across a market, human executives from competing companies had to get into a smoky back room or jump on a phone call and explicitly agree to establish a price floor. That is highly illegal. It is a textbook violation of antitrust laws because there is intent in communication.
But consider the current landscape.
Right. You have AI Agent A, owned by one institution, and AI Agent B, owned by another. Together, through various shell companies and property management firms, they might control 40% of the apartment inventory in a specific zip code.
But they are operating completely independently. They share no source code, they share no parent company, and no human executives are sending emails to each other.
Correct. But they share the same physical environment. Through millions of daily micro-adjustments and reinforcement learning, AI Agent A drops its price by $5 to try and capture a marginal tenant.
And then what?
Within milliseconds, AI Agent B detects the drop and instantly matches it. They both secure tenants, but they both lose long-term margin.
It makes me think of a flock of birds turning in unison. There is no leader bird calling out the coordinates. They are just mathematically reacting to the position of the bird next to them to avoid a collision. Over time, both autonomous algorithms implicitly learn that initiating a price war hurts both of their bottom lines.
Exactly. So without a single line of explicit code directing them to collude, and without a single human ever communicating, the machines reach a mathematical equilibrium. They learn to artificially hold the rent high, matching each other's incremental increases and refusing to match decreases.
They create an oligopoly of machines.
Yes, the traditional free market for residential rent ceases to exist.
So we have algorithms that have perfected the art of squeezing absolute maximum margin from the existing residential inventory. But yield-optimizing algorithms are inherently hungry. They constantly need new, cheap inventory to feed the machine and expand the portfolio.
And building new apartment complexes from scratch takes years of permitting and massive capital expenditure.
Right, so where do they find millions of square feet of cheap space? They look directly at the smoking crater of the commercial office market.
And we really need to pause and grasp the scale of that crater. We are looking at a $1.5 trillion macroeconomic time bomb.
$1.5 trillion. Let that sink in. Let's walk through the exact mechanics of this doom loop, because it isn't just an abstract Wall Street problem. It is a Main Street crisis. We have $1.5 trillion in commercial real estate debt maturing over the next 3 years.
And the crucial detail here, the thing that transforms this from a localized loss into a systemic risk, is who is actually holding the bag. It is not the mega banks. JP Morgan and Bank of America largely offloaded this toxic commercial debt years ago.
Right. The institutions holding this debt are the small, regional, and community banks. These are the mid-sized institutions that fund the local bakery, the dry cleaner, the neighborhood car wash. Their balance sheets are heavily concentrated in commercial property loans within their specific geographic footprint.
Let's break down the psychology and the cascading effect of this spiral, because it happens in very distinct steps.
Step 1 begins with the permanent shift to hybrid and remote work. That shift permanently destroyed the utility of traditional Class B and Class C office buildings. We are not talking about ultra-luxury, gleaming glass skyscrapers in Manhattan with pristine amenities.
No, we are talking about the 20-story concrete block office parks built in the 1980s in the suburbs of Cleveland or Dallas or Atlanta.
The physical structures are still entirely sound, but operationally they are ghost towns.
And the fundamental rule of commercial real estate is that the value of a building is not based on the cost of the bricks or the replacement cost of the seal. The value is derived entirely from the net operating income, the cash flow it generates from leasing out that office space to businesses.
So when vacancy rates hover near historic highs, the cash flow evaporates. That leads to step 2. Because the cash flow is gone, the building's underlying valuation plummets. It often falls 50% below the actual principal balance of the mortgage attached to it.
The property owner looks at their spreadsheet, realizes the asset is severely underwater, and knows they can never refinance it at current interest rates. Which triggers step 3, the strategic default.
Wait, so they just hand the keys back? I am struggling to see how a regional bank just absorbs a massive multi-million-dollar empty building without a fight. Surely they try to sell it.
They do try, but there are no buyers for empty Class B office space. The regional bank is forced to take possession of the asset. But a bank is a financial lender. It is not a property management company. It has no internal infrastructure to manage a vacant 20-story office building, secure it, or maintain its HVAC systems.
Right.
And more importantly, strict federal regulatory requirements force the bank to mark down the value of that newly acquired asset on its balance sheet to reflect current market realities.
They have to recognize the loss, and when they write down a $40 million building to $20 million, that $20 million loss comes directly out of their Tier 1 capital reserves.
Which brings us to the tipping point of the doom loop, step 4. To survive the regulatory hit and stay legally compliant, the bank has to conserve cash. They completely freeze their lending operations. They pull back all lines of credit.
And who do they stop lending to?
The small local businesses that rely on them for payroll loans and expansion capital, the local economic engine simply seizes up.
Which culminates in step 5, a localized recession. The dry cleaner next to the empty office building goes out of business because there are no office workers dropping off suits. The local bakery scales back. People lose their jobs.
And because the local economy is shrinking, surrounding property values drop even further, which triggers more defaults on other buildings, which hits the regional bank's balance sheet a second time. The cycle feeds on itself. That is the Dune loop.
Human developers, local politicians, and city planners look at that cycle and see a toxic, stranded asset slowly suffocating the local tax base.
But this is where the perspective shift occurs. Where the human sees a catastrophic failure, the AI cartel sees pure, unadulterated arbitrage. They see a generational buying opportunity to acquire raw square footage for pennies on the dollar.
But to understand how they actually pull this off, we have to talk about why human developers haven't just been turning all these empty offices into residential apartments for the last 5 years. I mean, it seems obvious, right?
It does seem obvious, but it comes down to what the industry calls the plumbing and light problem. It is a massive structural bottleneck.
Exactly. When you look at the architectural blueprints for a commercial office building, they are built with incredibly deep floor plates. The distance from the center core of the building where the elevators are to the exterior glass windows is huge, sometimes 50 or 60 feet.
And you cannot legally build a residential apartment without a window in the bedroom. It is a fire safety and health code violation.
So if a human developer tries to chop up an office floor into apartments, they end up with all this dead, dark, completely useless space in the center of the building.
And then you have the plumbing infrastructure. A standard commercial office floor is designed with maybe 4 large communal bathrooms clustered tightly around the central elevator core.
But if you want to convert that floor into 20 residential apartments, you suddenly need 20 individual bathrooms and 20 kitchens scattered across the entire expanse of the floor plate.
Which means physically drilling through thick post-tension concrete to reroute thousands of water and sewage pipes. It compromises the structural integrity of the building and costs an absolute fortune.
For a human architect, figuring this out is a nightmare. It requires a massive team of structural engineers, mechanical engineers, and architects spending 6 to 8 months conducting incredibly expensive feasibility studies just to figure out if a single building can be legally and safely converted.
But this is where the algorithmic advantage changes the math entirely. The institutional buyers are deploying advanced AI architectural models. Generative three-dimensional computer-aided design systems can ingest the complex structural blueprints and material data of an empty office tower, and in about 4 minutes, simulate tens of thousands of structural conversion permutations.
4 minutes instead of 6 months. The cost of analyzing a potential acquisition drops to nearly zero.
Down from 6 months, yes. And the AI immediately identifies the optimal structural solution, which is usually a hollow core strategy. The algorithm calculates exactly how to carve out the center of the building, dropping an interior light well or an open-air atrium straight down the middle of the tower from the roof to the lobby.
It literally cores the building like an apple.
Exactly. And suddenly, all of that dark, unusable interior square footage has access to direct sunlight from the new interior atrium. It instantly transforms dead space into legal, highly desirable residential square footage.
And what about the massive plumbing issue? How does the software solve drilling through concrete?
The AI runs fluid dynamics and structural simulations to automatically map the most efficient way to reroute the new plumbing network. It utilizes the existing elevator shafts and hollow structural columns as vertical chases, optimizing the pipe layout down to the millimeter to minimize the need for core drilling. It solves the plumbing and light problem algorithmically, generating permit-ready structural plans almost instantly.
So, the mechanics of the wealth transfer become clear. The institutional cartel sits back and watches the regional bank fail under the weight of the toxic debt. They swoop in, buy the bankrupt empty office tower from the distressed bank for 20 cents on the dollar, run the AI architectural conversion model in 4 minutes, secure the permits, and immediately start printing money by churning out high-yield microhousing.
It is a systemic wealth transfer. The wealth and equity are being forcefully drained from the local, regional banks that historically funded the local communities, and it is being transferred directly to institutional algorithmic cartels that operate on a global scale.
It is a ruthless execution of capital efficiency. But let's be honest, converting 50-story commercial skyscrapers is a game reserved for billionaires and private equity megafunds. It requires massive institutional capital. What about the independent listener, the mid-level entrepreneur? If artificial intelligence can read architectural blueprints and structural engineering data to find hidden physical value in a building, What happens when it turns its attention to the legal foundation of a city? What happens when it reads the municipal code?
This naturally leads us into AI zoning arbitrage. And this is perhaps the most actionable and fascinating vector for the independent entrepreneur. To grasp the opportunity, we first have to redefine what zoning actually is. Zoning is the ultimate real estate asset.
Right. The value isn't just in the physical structure or the dirt.
Yeah.
The true value is the legal right to build density on top of that dirt.
Precisely. You could own a vacant quarter-acre lot zoned strictly for a single-family home, and its fair market value might be $100,000. But that exact same patch of dirt, if the city council rezones it to allow for a fourplex apartment building or a mixed-use commercial storefront, becomes instantly worth $500,000.
The physical composition of the dirt hasn't changed an ounce. The legal code governing it has changed.
But navigating that municipal legal code is notoriously painful. Historically, human developers fail at this constantly. If you want to find an undervalued piece of land and change its zoning, you have to hire incredibly expensive land use attorneys who charge $800 an hour.
You have to hire local expediters whose entire job is to go down to City Hall, buy coffees, and schmooze the local planning boards.
Right. And you are dealing with a nightmare of data. You are parsing archaic, scanned PDF documents from the 1970s, full of contradictory bylaws, obscure setbacks, and historical amendments.
It is, at its core, an incredibly inefficient language and logic problem. And if there is one thing that advanced large language models excel at, it is parsing massive volumes of unstructured text, understanding the strict logical constraints within that text, and finding hidden anomalies that human eyes glaze over.
Exactly.
So if I am an entrepreneur looking to extract margin here, how am I deploying this? Because this sounds like flipping the regulatory system itself.
They are deploying what we call localized AI zoning agents. The entrepreneur takes an advanced large language model and feeds it the entire corpus of a city's data. We are talking about the full municipal zoning code, the transcribed historical minutes of every single city planning board meeting for the last 20 years, and the highly detailed geospatial data of the city's utility grid.
Meaning exactly where the heavy water mains are buried and where the industrial power substations are located.
Yes, and they set the AI loose to hunt across the geographic footprint of the city. The AI scours every single parcel of land, looking for what urban planners refer to as missing middle anomalies.
These are pockets of extreme value trapped by bureaucratic oversight.
Correct.
Let's make this concrete. Give me an example of a specific anomaly the AI would spot that a seasoned human land use attorney would miss.
Let's consider a transit-oriented density bonus. The municipal code of a major city might contain a buried, forgotten amendment stating that any parcel of land located exactly within 400 feet of a primary transit hub or a major rapid bus stop is legally entitled to build 3 extra stories of residential apartments without needing a special variance or public hearing.
Okay, but a human developer easily misses this because the city's official transit map is a poorly updated PDF from 10 years ago, and measuring 400 feet manually across irregular lot lines is incredibly tedious.
But the AI doesn't use the PDF.
No.
The AI pulls the real-time API data from the city's transit authority, cross-references it with the exact digital property lines from the county assessor's database, measures the distance down to the absolute inch, and flags a rundown single-family home that sits 398 feet from a new transit stop.
Wow. So the human owner thinks their property is worth $200,000, but the AI knows that, legally, it can support a multi-million-dollar mid-rise apartment building.
That is incredible. But finding the undervalued lot is only half the battle. You still have to prove to the notoriously stubborn City Planning Commission that you are legally allowed to build on it. The bureaucracy usually fights back.
And that is where the true value creation mechanism kicks in. The AI does not just flag the anomaly for the entrepreneur, it auto-generates the solution. Within minutes, it renders the architectural massing models, which are basic 3D block diagrams, to mathematically prove that a 4-story building fits perfectly within the legal setback requirements and height limits of that specific parcel.
And then it drafts the grueling 200-page environmental impact study and the formal variance application.
And because it ingested 20 years of historical city council meeting minutes,
Exactly. It uses that historical data to cite specific documented precedents where this exact same planning board approved similar variances for other developers in the past. It effectively bulletproofs the application against human bias.
Because it forces the board to either approve it or admit they are arbitrarily violating their own historical precedent.
You aren't flipping houses anymore. You're flipping the city's own legal code.
The AI is essentially a superhuman, encyclopedic land use attorney that never sleeps and works for fractions of a penny on the dollar. The entrepreneur buys the useless lot for cheap, uses the AI zoning agent to instantly secure the legal entitlements for high density, and then flips the paper, the newly entitled legal right to build, to a massive national home builder for an enormous, virtually risk-free margin.
They never even have to buy a hammer or pour a single drop of concrete. It is pure regulatory arbitrage. It is finding the financial delta between human ignorance of complex local laws and the machine's perfect instantaneous comprehension of those same laws.
Okay, let's take a step back and look at the whole board. We have AI setting the absolute mathematical maximum rent for residents. We have AI instantly redesigning dead commercial skyscrapers into micro apartments to create new inventory. And we have AI hacking the municipal zoning laws to flip legal entitlements.
We have completely mapped out the physical execution layer of the cartel.
But how does the capital actually flow to finance all of this? Because the old system relied on a local loan officer looking at a stack of pay stubs and pulling a FICO score. If the algorithms are running the real estate, they aren't going to rely on a manual credit check.
No, this is the crucial pivot into the 10-year outlook. It represents a total reimagining of credit, collateral, and risk. The traditional 30-year fixed mortgage, as we know it, is becoming a relic of the 20th century. And the foundation of that relic, as you mentioned, is the FICO credit score.
The dreaded FICO score. It has ruled our financial lives, dictated our interest rates, and decided who gets to buy a home for decades.
Because it was the absolute best centralized tool we had available at the time. But if we analyze it objectively, the FICO score is a remarkably blunt, historically biased, entirely backward-looking financial instrument.
Right.
All a FICO score actually tells the lender is your behavioral history of paying back specific types of debt in the past. It tells the bank absolutely nothing about your actual future earning potential, your current cash flow stability, or the macroeconomic trends affecting your specific career field.
So what replaces it? Because an AI cartel optimizing for maximum yield needs something infinitely more precise than a 3-digit number from a legacy credit bureau.
They replace it with continuous dynamic AI underwriting. When you apply for a mortgage or a property token in 2026, the AI underwriter does not look at a static snapshot of your previous tax returns. It evaluates your lifetime probabilistic cash flow.
And it builds this model by deeply analyzing your digital footprint. Now, when you say it analyzes my digital footprint, we aren't just talking about my browser history, right? We're talking about my literal financial discipline. And obviously you have to grant the algorithm permission to access this data in exchange for the capital.
Yes, you opt in to secure the loan. The AI ingests what we call your agentic commerce history.
So in plain English, it analyzes every digital transaction you make.
Exactly. It looks at what you buy, how often you buy it, and crucially, whether your spending patterns indicate erratic impulse control at 2 a.m. or steady, disciplined savings behavior. It monitors your utility payment consistency in real time. It analyzes your professional trajectory on networking platforms.
It cross-references your specific job title and industry with macroeconomic labor data to mathematically determine the statistical likelihood of your specific role being automated by AI in the next 5 years.
It is building a holistic mathematical simulation of your entire financial future to determine if you are a safe bet. It creates a highly accurate, forward-looking, probabilistic model of your ability to generate cash over your lifetime. But the underwriting revolution doesn't stop with the human applicant. It extends to the physical asset itself.
This is the transition toward what the industry calls smart assets and the true tokenization of real estate. This is where the mechanics get truly sci-fi, but it is happening right now in early markets. We are moving property deeds out of the dusty filing cabinets in the county clerk's basement.
Historically, proving you own a house meant paying a title company to pull a physical piece of paper filed in a municipal basement. In the tokenized smart city, the deed to the property is represented by an immutable smart contract on a decentralized blockchain.
And this smart contract is not just a passive digital ledger entry. It is actively, continuously linked to the physical reality of the house via a network of Internet of Things, or IoT, sensors embedded in the home's infrastructure.
Wait, so the legal smart contract that governs my mortgage rate is physically talking to the hardware sensors inside my living room walls?
Yes. And this architecture creates the dynamic mortgage. Your interest rate is no longer fixed at 6% for 30 years. It floats dynamically, recalculating constantly based on two continuous data streams.
Your real-time financial health and the real-time physical condition of the asset serving as collateral for the loan.
Walk me through a scenario. Give me an example of how the physical house talks to the mortgage contract to save me money.
Let's say the IoT sensors embedded in your central HVAC system detect that you are changing your air filters every 30 days with perfect consistency, ensuring the system runs efficiently. The humidity sensors installed in the basement confirm the space remains completely dry year-round.
Mitigating any risk of toxic mold or foundational rot.
Right. Structural sensors detect zero foundation settling. The AI underwriter of the lending institution receives this telemetry data continuously. It mathematically determines that you are an exceptional, proactive steward of the physical collateral, which significantly drops the statistical risk of catastrophic depreciation.
Because the risk profile of the loan has demonstrably dropped, the smart contract automatically, without any human loan officer intervening, lowers your interest rate by a fraction of a percent that very afternoon.
That sounds incredible on the surface. You get a financial discount simply for being a responsible homeowner and maintaining your property.
But what is the flip side of that hyper-efficiency? What happens when things go wrong? What if the macro economy dips and I lose my job?
In the legacy system, if you lose your primary source of income, you start making payments. The bank panics, you go into default, and you enter a messy, litigious 18-month human eviction and foreclosure process that completely destroys financial value for everyone involved.
The bank loses money on legal fees, and the house sits empty and degrades.
In the tokenized smart city, the smart contract is designed to avoid all of that friction and value destruction.
How does code prevent a foreclosure?
If the AI underwriter detects that your regular direct deposits have stopped indicating job loss, the smart contract instantly triggers an automated debt restructuring protocol. It might automatically lower your required monthly cash payment to a baseline level you can afford on unemployment benefits.
But the bank still needs to be compensated for the increased risk and the deferred interest.
Exactly. So to balance the ledger, the contract converts that difference into fractional equity. Every single month that you pay the reduced emergency rate, the bank automatically takes a 0.1% ownership stake in your house.
Wow. It just silently dilutes my ownership. I get to stay in the house, but I am slowly bleeding my equity back to the institution.
This raises a very important, almost philosophical question about the removal of friction in financial markets. What happens when the friction of foreclosure, the friction of refinancing, and the friction of human negotiation is reduced to a line of automated code executing flawlessly on a blockchain?
The absolute efficiency of the market increases dramatically, capital flows perfectly, but the human grace periods disappear entirely.
The sympathetic local banker who knows your family, who gives you an extra 60 days to find a job without penalizing you because they trust your character, that subjective human buffer is completely eliminated.
It is the ultimate double-edged sword. You get a cheaper initial interest rate because the system is perfectly efficient and risk is mitigated, but you are negotiating your survival and your wealth with a piece of code that has zero capacity for empathy.
Right.
So we have mapped out the entire machine. The algorithmic cartel controls the hyperlocal pricing, they control the redevelopment of distressed commercial assets, they control the municipal zoning hacks, and they control the continuous capital underwriting.
It is a closed loop.
Now, the most vital concern for the listener. We are watching this massive macroeconomic transition happen in real time. How does someone position themselves to survive, protect their margins, and actually thrive in this new algorithmic grid? Let's open up the playbook. We need concrete, actionable vectors.
We need to distill these massive shifts into specific steps that affect wealth. The opportunity here isn't just in observing the change, it is in providing the infrastructure for it.
Let's start with playbook step 1. Shorting regional commercial real estate debt. We talked about the doom loop extensively earlier. The $1.5 trillion in toxic office debt sitting heavily on local bank balance sheets. If I am an investor looking at that crater, how do I actually play that?
This is a macroeconomic trade. If you analyze the timeline and believe that the generative AI architectural conversions we discussed will take a few years to scale fully, and that the vulnerable regional banks will buckle and fail before they can successfully liquidate those distressed assets, the strategy is highly targeted.
You identify the specific publicly traded regional banks with the highest concentrated exposure to underwater Class B commercial office debt in their lending portfolios.
You are looking for banks in secondary marketplaces heavily dependent on older office space. During the inevitable panic, when these banks are forced by regulators to write down their capital reserves, their equity valuation will plummet. Retail investors can short the equity of these specific banks.
For institutional players, the play is stepping in during the bankruptcy proceedings and buying that distressed commercial debt from the failing bank for 20 cents on the dollar, holding the underlying real estate specifically for future AI conversion when the technology matures.
Okay, so that is the aggressive financial engineering play. But let's pivot to the technology side, which feels like a much wider runway.
Playbook Step 2. Investing in the digital MLS. The current multiple listing service, the database that every single human realtor uses to see what houses are for sale, is completely archaic. It is fragmented across hundreds of localized associations. The data entry is messy and subjective, and it basically just tells you how many bedrooms a house has, what the school district is, and what the asking price is.
It is entirely insufficient for the algorithmic era. The wealth in this transition is not necessarily going to the people who own the physical dirt or the bricks. It is going to the PropTech data monopolies that are actively building the unified APIs, the application programming interfaces.
The toll booths. I love this concept.
Exactly. The digital toll booths. Imagine a unified national API platform that aggregates not just the basic listing price of a home, but the high-resolution LiDAR topographical data of the physical lot, the precise parsed municipal zoning code limitations we discussed earlier, the complete historical municipal permit history of every renovation, and the real-time utility cost averages for that exact parcel.
And here is where it gets incredibly lucrative. Every single AI zoning agent, every institutional algorithmic underwriter calculating lifetime cash flow, and every dynamic pricing bot setting daily rent needs that structured data to function. They are blind without it. They cannot operate in the physical world without a map.
So if you were a software engineer or an investor, and you build or fund the API platform that structures, cleans, and hosts that physical data, you become the toll booth on the digital highway.
Every single time a cartel algorithm wants to assess a piece of the physical earth, it has to ping your server, and it pays you a microtransaction. You don't have to own the real estate, you own the infrastructure of the cartel.
Which perfectly bridges into Playbook Step 3, AI Property Management as a Service. We established that the institutional cartels are buying tens of thousands of homes. But as advanced as they are, algorithms cannot physically fix a broken water pipe.
Right. Code cannot unclog a toilet. Software cannot patch a leaky roof. The digital cartel, despite all its mathematical perfection, still has to interact with the messy, decaying physical reality of entropy.
And they despise that part of the business. Wall Street institutions want to be pure, frictionless financial yield engines. They absolutely do not want to manage human resources departments, deal with localized maintenance crews, or handle workers' compensation claims for plumbers in 50 different cities.
So the massive opportunity for the local entrepreneur is to build the physical execution layer for the digital cartel. Walk me through exactly how that works in practice. How do I build a service network that caters to an AI landlord?
You build a localized, API-driven dispatch and service network. When the AI landlord's IoT sensor in a tenant's basement in Dallas detects a sudden drop in water pressure indicating a burst pipe, your software system receives the automated dispatch from the AI instantly. No human tenant even had to call it in.
Your system automatically pings a local, vetted, gig economy plumber who is part of your network. It sends them the exact GPS coordinates, the entry code for the smart lock, and the precise diagnostic telemetry data from the burst pipe sensor.
The gig worker plumber arrives and fixes the pipe, but there is no human property manager on site to inspect the work and authorize payment. How does the cartel know the job was actually done correctly?
The plumber finishes the job and puts on augmented reality glasses, or simply uses the high-resolution camera on their phone to scan the repaired section of pipe. Your computer vision AI analyzes the scan, cross-references it with building code standards, and verifies that the weld is structurally sound and the leak is entirely resolved.
The moment your AI verifies the physical repair, the smart contract on the blockchain triggers. settling the payment instantly in stablecoins.
And just to clarify, why stablecoins instead of just doing a direct bank transfer to the plumber?
Because stablecoins cryptocurrency pegged to the US dollar allow for instant, trustless settlement 24 hours a day, even on weekends when traditional banking infrastructure is closed. The plumber gets paid the exact second the camera verifies the work, which incentivizes them to prioritize your network's jobs.
You, as the creator of this localized service network, take a 5% margin on every automated repair dispatch across the entire city. You become the indispensable, highly profitable physical arm of the digital landlord, entirely insulating yourself from the massive capital debt of actually owning the buildings.
It is brilliant. You extract margin from the entropy and maintenance of the asset class. The playbook sounds incredibly lucrative if you are a builder, a software engineer, or managing a cartel.
But we cannot just look at the spreadsheets and the margins. We have to look at the other side of the ledger. What does this level of ruthless algorithmic efficiency mean for the average listener who is just trying to find a home, who just wants a stable place to raise their kids? We have to look at the deeply concerning societal fallout. Let's explore the dark side.
We must dedicate significant time to the risks, the failures, and the controversies here. Because when you entirely remove human empathy, local context, and community governance from the physical earth, you risk creating an optimized system that maximizes capital yield at the direct expense of human flourishing.
Let's start with a concept that is frankly terrifying when you dig into the mechanics: algorithmic redlining. We know that in the 20th century, human redlining was this clumsy, illegal, and deeply racist practice, where human bankers would literally draw red lines on physical maps and refuse to lend money to minority neighborhoods.
It was evil, but because it was perpetrated by humans, it left a paper trail, it required explicit intent, and it could be systematically fought and dismantled in federal court.
Algorithmic redlining is entirely invisible, and because it operates purely on complex mathematical correlation rather than intentional human malice, it is legally and practically much harder to fight. The AI underwriters will silently starve entire zip codes of capital if they find statistical correlations with future risk, regardless of the human cost.
Give me an example of the risk data they are looking at. What causes an algorithm to abandon a neighborhood?
Climate risk data is becoming the largest single factor. If the cartel's predictive models forecast a 30% increase in flooding probability, or a severe escalation in wildfire risk over the next 10 years for a specific coastal or forested zip code, the algorithms will instantly and simultaneously pull all underwriting capital from that area. They don't wait for the disaster to strike.
Alternatively, the algorithms might detect a subtle correlation with localized social unrest based on social media sentiment analysis, or identify a slowly declining municipal tax base that statistically indicates future public school closures and rising crime rates.
So without any human executive making a conscious, deliberate choice to abandon a community, the distributed machine intelligence just decides that the zip code is mathematically suboptimal.
And suddenly, nobody in that neighborhood can secure a mortgage to buy a home. Businesses can't get loans to expand, and the automated insurance algorithms price the hazard premium so astronomically high that they are completely unpayable for average families.
Exactly. The algorithms build invisible, mathematically impenetrable walls around wealthy, climate-resilient enclaves that possess positive data profiles, while quietly condemning other neighborhoods to a total freeze in capital liquidity. You cannot sell your house to escape because the machine flatly refuses to finance the incoming buyer.
Which brings us directly to the human story at the center of this: the societal impact on the middle class. We are looking at the accelerated death of the starter home and the intentional creation of a permanent renter class.
Let's paint a picture of what this looks like for a real family trying to enter the market in 2026. You have a young couple, they have lived below their means and saved up for 5 years, they have a solid 10% down payment, and they want to buy a basic entry-level 3-bedroom starter home in a decent school district.
In the old inefficient market, they competed against other local families with similar resources. Today, they are competing directly against the hyperlocal yield management AI we discussed at the very beginning of this deep dive. And mathematically, the AI will systematically outbid them every single time a property hits the market.
Walk me through the math of why. Why does a multi-billion-dollar institution want that specific modest starter home so badly that they will overpay for it?
Because they aren't actually overpaying based on their models. The institutional AI can underwrite the future risk and the yield of that physical asset far better than a local bank can underwrite the future income of the young couple. The cartel knows definitively that it can acquire the home, instantly deploy its automated property management software, and optimize the rent dynamically based on local cell phone pings and job postings.
The algorithm calculates the absolute maximum present value of that perfectly optimized dynamic future rental income.
Because its cost of capital is lower and its projected yield is perfectly optimized, it bids exactly that calculated maximum amount entirely in cash milliseconds after the house hits the digital MLS via API.
The human family, relying on a slow, human-approved 30-year mortgage that takes 45 days to close, doesn't stand a chance against a millisecond cash offer. The entire inventory of entry-level starter homes is systematically vacuumed up by the machines and converted into permanent rental yield vehicles.
This leads us to the grim reality of corporate neo-feudalism. We have to understand the historical context. For the last 80 years following the Second World War, the primary vehicle for middle-class wealth generation in the world has been the equity appreciation of the family home.
It acted as forced savings, it stabilized communities, and it built generational wealth that could be passed down.
But in this new algorithmic paradigm, the middle class will no longer own the underlying equity of their shelter.
They will merely subscribe to it, like a software service.
They will pay a dynamically priced, constantly adjusting daily rent to a faceless, yield-optimizing server farm located 1,000 miles away. You are no longer a homeowner slowly building equity and a stake in your community. You are effectively a digital serf, generating frictionless financial yield for a remote algorithm.
I am genuinely concerned by the trajectory of this. When you look at the macro trends, we are financializing the global dream of property ownership to the point of extinction. It begs a massive question. Is perfect market efficiency, frictionless blockchain transactions, and flawlessly optimized asset yields really worth it if it means you have to rent your life from a machine?
You have absolutely no equity in the very earth you stand on.
It is the ultimate contrarian realization of our era. For decades, the tech industry and consumers alike spent their time begging for more data, more efficiency, and less friction in the real estate market. We wanted the instant one-click mortgage. We wanted the automated valuation models to be perfectly accurate. We demanded perfect market transparency.
Well, we got exactly what we asked for. The market is now perfectly, ruthlessly efficient. And we are discovering, perhaps too late, that perfect mathematical efficiency leaves absolutely no margin for human grace.
Okay, let's land this plane. We have covered an immense amount of ground and technical architecture today. I'm going to deliver a swift 3-bullet recap of everything we just mapped out so you have the core takeaways. Number 1, residential rent is no longer a free market governed by local supply and demand. It is being dynamically fixed by hyperlocal yield management AI that measures your exact behavioral price elasticity and implicitly colludes to eliminate price drops.
Number 2, the $1.5 trillion commercial real estate doom loop is exposing regional banks to catastrophic failure, but it is simultaneously creating a generational arbitrage opportunity for cartels using generative AI architectural conversion tools to instantly reroute plumbing and light.
And number 3, the wealth playbook in this new era does not require owning the buildings. It lies in deploying AI zoning arbitrage to flip municipal legal codes, building PropTech API toll booths to charge the algorithms for physical data, and establishing the automated gig economy service layers the cartels rely on.
The transition from trading physical dirt to managing digitized algorithmic nodes is already well underway. The fundamental rules of property have changed.
When you look at your own neighborhood, when you prepare to sign your next lease or apply for your next mortgage, you are now operating inside this algorithmic grid. I want to leave you with a deeply personal, provocative thought to mull over this week, especially in light of the corporate neo-feudalism we just unpacked. If an autonomous AI landlord could adjust your rent daily, based precisely on your shifting income, your changing commute time, your digital spending footprint, and hyperlocal neighborhood demand, would you ever be able to truly own your financial future? Or is the traditional starter home already dead, quietly replaced by a permanent, inescapable digital subscription to human shelter?
It is a question that demands an answer from all of us as we figure out how to live and invest in this new economy.
We want to hear your thoughts on this down in the comments. Let us know how you are seeing these algorithms impact your local market. Remember, this deep dive is entirely for educational commentary. We are mapping the territory and analyzing the data, but you must do your own research and consult professionals before making any financial moves. Stay curious, stay positioned, not financial advice. Do your own research.